All right, let's talk about Franco Nevada, a real heavyweight in the world of mining finance. You see, based on their latest numbers, they didn't just have a good quarter, they had an absolutely golden one. So what happens when a company that's built for a gold rush suddenly finds itself smack in the middle of one? Well, let's find out. So let's just start with the headline number, because honestly, it is a jaw-dropper. In the last quarter of 2025, Franco Nevada's revenue rocketed up by over 86% compared to the same time last year. Look, that's not just growth, that's an explosion. A number like this tells you right away that something really special was happening, mostly thanks to soaring prices for precious metals.
And it's not like people didn't see a good quarter coming. They did. They just didn't see it being this good. Analysts were forecasting around $542 million in revenue. But Franco Nevada, they blew right past that, pulling in almost $600 million. They didn't just beat expectations, they absolutely smashed them.
And that incredible fourth quarter, well, that was just the cherry on top of what the company's CEO called a record-breaking year. For all of 2025, their revenue jumped by about 64%. And even better, their adjusted net income soared by almost 74%. This wasn't just some flash in the pan. This was a whole year of powerful, sustained performance. So what does all that actually mean? It means they pulled in over $1 billion in annual earnings. But here's the killer stat for me, the margin. A 60% earnings margin is, well, like their CEO said, a level of profitability that's impressive in any sector. So the big question has to be, how on earth do they do it? Right? So the secret sauce here, it's not about digging in the dirt or driving huge trucks. The real secret is their business model. Franco Nevada is what's called a royalty and streaming company. And let me tell you, it is a brilliant way to play the mining game. And this pretty much sums it up perfectly. Think of them like a specialized bank or maybe even a landlord for mining companies. They give miners a bunch of cash up front, right when they need it to build or expand a mine. In return, Franco Nevada gets a small piece of everything that mine ever produces for the rest of its life. And they do it without having to pay for the day-to-day costs. It's all the upside of high gold prices with almost none of the operational headaches. Now, this model works especially well when you're betting on the right horses. A whopping 85% of their revenue in 2025 came from precious metals. That put them in the perfect spot to ride the wave of high gold and silver prices. That other 15%? Well, that just gives them some nice diversification into things like energy. And if you want the ultimate proof of just how powerful this business model is, just look at this number, a 91% adjusted EBIT margin. I mean, that is just efficiency on a completely different level. It means for every single dollar of revenue they bring in, 91 cents flows right through as gross profit. It is a cash-generating machine.
So, okay, they are absolutely printing money. The next logical question is, what are they doing with it all? Let's take a look at how they're using this incredible financial strength to build for the future.
Simply put, they're building a fortress. First off, the company is completely debt-free, not a penny. On top of that, they're sitting on a massive war chest of about $3.1 billion in capital, all ready to go for new deals. And if that wasn't enough, they also hold over $1 billion in shares of other public companies. They are in an unbelievably powerful position. And their strategy for using that money is crystal clear. As their CEO, Paul Brink, puts it, they act as the financial bank of strong teams. See, they don't just buy assets, they invest in proven, successful management teams that they know can get the job done. It's a bet on people just as much as it is on the rocks in the ground. And because of all the deals they've already made, they have a really clear growth path that's basically baked right in. Even if they don't make a single new deal, their existing projects are set to grow their production, which they measure in gold equivalent ounces, or GEOs, by about 13% by 2030. That's their baseline. That's the floor. But, and this is where the story gets really interesting, beyond that solid, predictable baseline growth, there is a massive wild card in their portfolio. We're talking about an asset so significant, it could completely change the entire game for them. So what would happen if their single biggest development asset, the gigantic Cobra Panama mine, were to restart operations? Now, the company isn't including a single ounce from it in their official guidance, but the potential here is just enormous. This slide really tells the whole story, doesn't it?
On one side, you have that solid, reliable 13% growth baked in by 2030. But if Cobre Panama comes back online, that number leaps to roughly 45%. The restart of just this one asset could more than triple their organic growth rate. That is a game changer. Okay, so this brings us to the final takeaway. When you put all the pieces together, the amazing results, the powerful business model, the future growth, you're left with this fascinating picture of massive opportunity and very real risk.
It really all boils down to this classic trade-off, right? On one side of the ledger, you've got a financial fortress, debt-free, high-margin business model, you name it. They've got a clear path to 13% growth with the potential for that incredible 45% upside. But on the other side of the ledger, they're still exposed to volatile commodity prices. And that huge growth catalyst, Cobre Panama, well, its restart is far from a sure thing.
Which leaves us with one last big question. Franco-Nevada has built this incredible business that is just firing on all cylinders. They have a clear, safe path for growth. But is the massive company-changing potential of Cobre Panama, the very thing that offers so much incredible upside, also the single greatest risk hanging over its future?